Welcome to AI Finance Daily, the show that makes AI economics make sense. Most people are getting this wrong. Today, we fix that. The subject: I ignored AI for 18 months. My portfolio is down 40% because of it. Ignored. That's the word that resonates heavily with many who found themselves on the wrong side of the AI revolution. A year and a half ago, the signs were unmistakable. Companies like Nvidia began to lift business forecasts, and yet substantial skepticism remained. Traditional narratives around tech investing emphasized profitability, stability, and a more conservative approach, fearing the volatility inherent in emerging sectors. However, those investing decisions ultimately cost many dearly, myself among them. While Nvidia ballooned nearly 400% from its early 2023 lows, my portfolio, constrained by lagging indicators and old paradigms, fell about 40%. The conventional wisdom around tech sector investments tends to focus too heavily on the past, tethering it to outdated metrics that no longer apply in a rapidly evolving landscape. Why is this happening? One substantial shift lies within the fiscal and monetary policies actively shaping our economy. The explosion of generative AI has provided companies a path towards efficiency and enhanced productivity. A recent Deloitte survey indicated that 97% of executives see AI as vital to their organizations, representing a seismic shift in focus. Yet many continue to view AI as a niche technology, rather than as an integrative force that impacts various sectors. Here's why this matters to you specifically. Ignoring AI en masse could lead investors to miss out on transformative profitability. Major institutions and successful startups are integrating AI in ways that restructure traditional profitability models. One recent analysis indicated that the global AI market could grow from roughly $100 billion today to around $1 trillion by 2030. If an investor fails to recognize this shift, they risk missing out on the next major wave of wealth generation. This is where the conventional wisdom breaks. Many hold tight to analog methods of evaluating firms, leaning on metrics like price-to-earnings ratios that reflect older paradigms, completely overlooking the potential breakthroughs that AI can facilitate. Notably, the number everyone missed is the projected boost in productivity growth, which, according to estimates, could rise from an average of 1.5% to potentially over 3% annually, meaning the economic output per hour worked could nearly double. The stakes for everyday investors are high. If you remain fixed in an old mindset, you could face the reality of a shrinking portfolio against the backdrop of a transformative economy. Real estate firms, logistics, healthcare, even defense, companies across sectors are integrating AI to enhance efficiency and cut down long-term operational costs. Imagine if your investments in traditional firms continue to lag, while companies leveraging AI see exponential growth. Reflect for a moment. When analysts often highlight risk, they rarely emphasize the opportunity cost associated with inaction. The regret here isn't tied merely to missed returns. It's a broader indictment on the decision-making framework once used. A fixation on what was perceived as steady resulted in the overlooking of pioneering companies that could dictate future market settings. Is that a familiar narrative? Decisions based on outdated information anchor individual choices, leading to regret. The misjudged assumption was that AI would take much longer to mature than it actually has. Neither the public nor professionals anticipated how quickly the landscape would shift. As a remedy, the change must occur in how investors parse information and approach decisions. Instead of relying solely on time-tested indicators, the focus should shift toward understanding evolving technology and its implications for all sectors. What could an investment thesis based on forward-looking variables look like? One solid change here could be actively seeking out innovative companies that prioritize incorporating AI tools into their structures, and keep a watchful eye on market trends and emerging growth sectors. This is not simply another wave for passive observers. This is a call for active engagement with the evolving economy. Consider this an invitation to reevaluate your frameworks. A fundamental question arises. Are your current investment strategies aligned with how the future looks? Or do they reflect a past that may no longer serve your financial interests? This requires not just a reevaluation of priorities, but a commitment to continuously assess evolving data and narratives. Embrace change, lest you be left behind. The next vital frontier in finance awaits. Make sure your roadmap is equipped for it. That's AI Finance Daily for today. If this made you see something differently, share it with someone who needs to hear it.